That talks really, what we've gone through is just kind of the general types of properties, et cetera. This right here is more kind of in the financial side of things. So cap rates are by far probably the most important metric that you'll see across the board when it comes to commercial real estate. So it's a very simple formula. It's the net operating income, and that's what NOI is. Net operating income divided by the purchase price. So for example, there is a $55 million building for sale. It's the NOI, the net operating income, is $7.5 million. That's 13.6% cap rate. That's now why you need to know cap rates is because valuations are 100% revolved around cap rate. This formula right here gives you the value of the property. Now, when you're thinking about this, what you need to know as a commercial broker or someone that knows the industry is office space is at a 10% cap rate. That's what it trades at. Triple net investments, like a Starbucks, can go as low as 4.5%. Now, you might have other things that might trade for higher, but on average, we're seeing 6 to 7% cap rates across the board. Industrial, it could be very low. Again, this is very location dependent as well. Industrial cap rates in Manassas versus industrial cap rates in, Roanoke are not going to be anywhere near the same. So local demand is what drives the value for that area. Now, if you have a good idea of all the values or what the cap rates are across different industries and different areas, it's very easy to, hey, this apartment building has $1 million net operating income after all expenses, right? So this is going to be a $10 million valuation, for example, and I can sell this, for this rate. This is the two main reasons you want to know this. You want to know it for resale purposes, and you want to know it for refinancing purposes. Commercial loans are typically a 5-year term, 7-year term. So occasionally you'll get 10, sometimes it's longer, but 5 and 7 is usually when it needs to get refinanced. So all the big news that you've been hearing for the last probably 3-4 years now about COVID and office and even multifamily, and it's going to come crashing down, is because they know that these loans are going to come crashing or supposed to come crashing because the rates were at 2.5%, 3%, 4%, and now they're going to go from that rate all the way to 7%. So, and here's probably the other big thing with this. If you have a 7% interest rate and the cap rate is 7%, you're not making any money. It's literally the delta is where you make the profit. So if you can buy a property at a 13% cap rate and the interest rate is at 7%, then that's your profit rate right there as a percentage. Did I miss anything? I think
it can get complicated, but cap rates there's a direct relationship with how the market's doing. If there's less demand, cap rates go up because investors don't want to pay as much for an investment. So a cap rate is really a measure of how well that property is doing from an investment perspective.
Yeah.
Cash on cash return, and we'll keep this basic, but essentially it's your cash on cash return is, okay, you've bought a $10 million building, I put a 20% down payment on this property, which means that I put $2 million into this property. What is my cash on cash return? Basically, what is my cash return that I'm making on this property compared to the cash that I actually put into the property itself? And an internal rate of return usually relates to an entry and an exit of an investment. If you've heard of what syndications are. So syndications are like crowdfunded investments. They generally have an IRR attached to them because there's an entry and an exit, and this measures the rate of return based on this entry and exit. So all these terms are related to investment, particularly investment real estate. Financing, commercial, let me kind of just rolls into it. So with financing commercial deals, this is kind of a summation of what you'll see out there right now. It's a snapshot of the market right now. These things change on a quarterly basis. They might change if the Fed raises the rates or lowers the rates. It's crucial to really understand how financing affects your clients when it comes to commercial real estate. Absolutely crucial. Probably even more so, in my opinion, than residential. The reason why is because, for example, if you look at loan terms, a typical residential mortgage is amortized for 30 years, right? And it's due in 30 years. With commercial, the max that you'll see generally is 25-year amortization. So they'll pay for this loan as if it's a 25-year loan, but it's due in 5. There's a balloon payment attached to that property that's due between 5 and 10 years, depending on the type of property and the investor portfolio and stuff like that. So it's really important to understand, okay, the return on this property over the next 15 years, if this tenant vacates, right, year 9, and the loan is due year 10, what's going to happen to my client if he can't find an investor, or sorry, a tenant to replace that investment income? He's going to be in deep waters. So that's why it's really important to understand this. 60 to 90% loan to value. Most of these properties, if it's an SBA loan, for example, you can get away with a 10% down payment on an owner-user property. But if it's investment real estate right now, with where the market sits, you'll probably see them between 20 to 40% down payment, depending on the product, depending on the client. Rates right now are probably closer to 6 and 7%. We've seen 6.25 right now, but it's kind of pushing up there. And then your debt service coverage ratio is also a very important figure. So it says it right there. So the minimum ratio of net operating income to the debt service required by most lenders. What is my return based and compared to how much my debt servicing is? So they want to see 1.25 more investment than what they're servicing on the debt. So again, very important to keep these in mind. They will calculate into, when you're running these scenarios with your clients, you have to keep this top of mind.
One of the most important relationships a property owner is going to have for commercial real estate is with their banker. It's definitely much more one-on-one. You know them probably on a first-name basis. They're going to keep checking in. You will see commercial lenders, loan officers, actually go drive by a site and make sure, hey, this development project's still going through, or this tenant actually was placed. So again, all valuations for commercial real estate are based on net income. So if you can get the net income there, and you can make sure that that's going to transition you to your next refi period, that's the most important thing.
Next slide.
All right, so we will be talking about investor and what they're looking for. So typically when an investor is looking at something, generally speaking, the way I kind of see it in my mind is you really have two types. You have somebody that's 65 years old. They're really looking to just park their money and just make a stable return, but they don't want to be in the stock market, for example. They're looking for a stabilized core investment. What that means is that they want a strong tenant. They want something with a long lease. They don't necessarily care about the highest rate of return. They just want a safe, steady return for the next however many years. So that's typically what we see when we say core or stabilized. Now, value add is where things that, hey, this raw piece of land, I can rezone it, and now I'm going to triple or quadruple the value. That's a value add. A flip, right? If we take this to a residential level, right? You're flipping this house. Now, it could be for a rental or it could be for a sale, right? But what you're doing, you're creating forced appreciation. You're not waiting on the market to appreciate and, hey, yes, I banked 30% because the market, went up 10% every year. No, you want to create the greatest amount of appreciation in the shortest time possible. And again, probably the best example in commercial real estate. Let's say that someone has had a shopping center, and you'll see this actually quite a bit. A landlord that's owned this place for 50 years, has been in the family, and they just really haven't raised rents to market. A new operator could come in without doing any upgrades, right? Basically increase the rent for these people. If you increase, let's say the rent is $10 a square foot and it goes to $15 a square foot, now you've increased the value 150%. So now you can go to a bank and do a cash out refi, right? So very similar concepts to a flip, but you're doing it on a much larger scale, and now you have that forced appreciation. The things that we're looking for when we are talking to an investor, how long do you want to hold this property? Is that going to be a long-term or short-term? What's your target cap rate? How much cash flow do you want a month? Cash flow per month versus cap rate could be completely different because cap rate is the delta between your interest rate and your interest rate and the cap rate itself. Now, if you're at 7 and 7, yeah, technically on paper you're okay, but there's no cash flow there. So that's kind of the thing that we're looking for. Like somebody's like, I want to make at least $100,000 from this property a year. I want to be able to live off of this property. Well, we're going to take a look at that completely differently than just a cap rate perspective. ROI threshold, so that's just return on investment. Again, that's a very cash-on-cash return. Cash-on-cash return is more focused on, I would say, a buy and holds versus buy and sells or buy and exits. And then you have investors that are just focused on one property category. So what type of investor is this? Is this person a general investor? Are they do they just want to stick into industrial? Do they know how to develop it, et cetera? And then what is their exit strategy? So really 2 exit strategies. Is it going to be a refi or is it going to be a sale? And that's typically what you're looking at. You want to go through due diligence?
We got some more slides with other profiles. You go ahead. Okay.
So we have due diligence. Now, the first thing that we want to do with any type of buyer, but especially investors, is a financial analysis. Do they have the cash? Can they go take this to a bank and get a loan? What's going to be the amount that they get to? Really, you want to take a look at their global cash flow situation and what their cash flow situation is going to be for that property as well. Again, you don't need to do all the work yourself, but it helps to do some of the due diligence and connect them with the right lender so that they do that work and you can trust what they're saying to you. Market and asset analysis. So what assets do they currently own? What is their value? What is their experience? Risk mitigation. What does their next 10 years look like? Are they planning on retiring? Those are things that you might. They're more the soft skills that you want to at least have in the back of your pocket to make sure that this person isn't, they're up here, they're ready to do everything, and they're just they're not really mitigating their risk at all. Our first client ever, great client. We've done 5 transactions with her, but she was very risk embracive. And basically now we've had to sell the first property that she ever brought because she just couldn't afford to actually do what she wanted to do. So they could be great clients, but you want to create those long-term relationships and make sure that their risk is actually being managed for them in some cases. You want to take a look at regulatory and tax. So again, you don't want to give tax advice, but you want to have a general idea of what tax implications there could be. So for example, you can take them to the accountant, lawyer, whatever. And then cash on hand. That's definitely the number one thing. It also can't be in their mattress. So same things that you guys deal with as residential agents. You want to make sure that they have that cash on hand and it's accessible, it's verifiable.
Oh yeah, this one is very fun. Probably honestly, we love working with tenants because one of the things that attracted us to this line of real estate was helping folks achieve their dreams. The first property that we did was it was a daycare center for a lady that came out of a home daycare. I was circle prospecting around a listing I didn't even have. I was so desperate for a listing at that point. And it was on, I won't say the name, but I called her and she said, look, I don't want to sell my house, but I'm running a home daycare and I'd love to get into a center. I was like, we know everything there is to know about daycare centers. We'd love to help you. Sure enough, within 7 months, we got her into a daycare center. And that was just emotionally for me, spiritually, was something that really drove me to see that. We got her from 12 kids in a home to 110 kids, from 1 or 2 employees to like 16, 17. So we help somebody achieve their dream in real time with an asset. Huge driver for us. And it starts here. A lot of the volume that you'll work with and a lot of the calls that we get from Samson agents are for a tenant rep. But this is where you can spin your wheels, because we've learned this the hard way. 90% of the folks that you'll talk to, if I'm being frank, are just not ready to do it now. You can set them on a track to help them get to where they're ready for brick and mortar, but you really want to do a very good consultation to make sure that you're doing proper due diligence, make sure that that client is ready. You also want to do the math on the commission, right? So the way that you get paid as a tenant rep, if they're leasing space at $50 a square foot and it's 1,000 square feet, you're going to get paid on however long that term is. Let's say they sign a 10-year lease and they're paying $40 a square foot. Okay, for 10 years, they're going to pay, let's say $500,000, just throwing out a number. Well, you're probably going to get paid around 3% on that. Is that going to be worth the time? Our average turnaround time from finding a tenant, starting to show them locations, and landing a contract is 149 days. 149 days that you're committed to this client with diligent work. So you want to make sure, if I'm going to make $10,000 off a 149-day client, is that worth my time? That's going to be a calculation you have to figure in. So with tenants, you want to figure out on your consultation, find out what their business needs are, figure out where they're at in their business now, and why they need more space. You're going to ask a lot of why questions. Why they need more space? Where is their operation going? Can they grow into the space? If they're signing a 10-year lease and their trajectory is like this, all right, we want to make sure that we're giving you guys enough space over the next several years to grow into. Budget and lease terms. How does paying now a significantly increased lease going to affect their bottom line? The attrition rate for mom and pop businesses in this country is over 90% in 5 years. 90% of mom and pop businesses fail within 5 years because they don't really understand their numbers. We've seen this a lot. So you got to help them figure out sometimes, how does you're paying this lease amount going to affect your bottom line? Can you grow into that? Growth expansion, we kind of covered how they're going to expand in that space. The risk tolerance, when you're signing a lease, especially retail in a decent center, you're going to personally guarantee this lease. And so is your spouse. So if you're a brand new startup and you don't have a corporate-backed guarantee, like Wendy's, for example, you're going to personally guarantee that lease, and your spouse is going to be on that as well. If you default, laws are a lot more lenient on commercial tenants than residential tenants in this area. So they're going to come after you. So you want to make sure that you understand the risk, or well, they do, understand the risk, understand their projections, and they're okay signing their name and their spouse's name on that lease. When we get into due diligence on your end, what's your suitability? Like looking at the space itself and how it's currently built out. Are they going to have the cash to restructure this place and make it into a restaurant or whatever, right? Does the zoning allow for this? So I'll give you kind of a quick example. We're running right now with a lady that wants to do a play cafe. So she wants to do a structured play for kids, 2-hour blocks, and then build out a small coffee shop for the parents while they wait. Great concept. We're thinking, in my mind, that's retail. Coffee, indoor recreation, that's retail across the board. I'm not going to have any problems with zoning. So we get to work, we find a location, we submit a letter of intent, and we're going through the blocks, and she just happened to be like, you know what, let me just check to make sure the zoning is good here. She actually reaches out to the county in Loudoun, and they're like, oh yeah, your use is not allowed here. You're actually going to have to go through a special exemption process. It's a 9-month process. It's going to cost you $6,000 just to make sure that you're able to use this space. So we had to go back to square one. So I came with an assumption thinking, oh, retail, we're good to go. This is the due diligence you want to do up front so you're not spinning your wheels. Analyzing the lease with them, AI has been a great tool for us. It's been fantastic. You don't want to rely on it fully, right? But when you plug it in, hey, give me kind of the basic terms here in this lease that I need to focus on, and it kind of spits out a bit more of a structured meeting for you and your clients. A little caveat here, I think I should say. When it comes to lease contracts, this is a legal document. Most of the tenants that you'll be working with, most spaces, leases are between 15 and 50 pages. They can range. Those leases are hardcore. So they're legal contracts. You don't give legal advice. That is beyond the scope of your license. You want to be very careful. So the very first thing we do when we get to this stage, after we get past the letter of intent stage, if we have a contract in our hand, the immediate thing we do is connect them with a lawyer if they don't have one. Hey, you need a lawyer to review this contract, so you make sure you understand what you're signing here. You can give general advice based on the base terms that you've negotiated in the LOI, but you really want to avoid giving any legal advice. Market comparisons, obviously running the same things that we do in residential. You'll do that here based on the region that they're in. What are you going to pay here based on here? Tenant improvements, this is huge. So TI, tenant improvement allowance, is what you'll negotiate with a landlord to refund your tenant, your client, at the time that they open for the work that they put into this place, improving their real estate. And TI can depend on a lot of factors. It can depend on the landlord's cash ability to put into the space. It can depend on how big that landlord is. We've worked on spaces where the landlord's an international organization in 50 countries. They're giving us $140 a square foot in TI, which is probably $400,000, that they're refunding this tenant at the time that they open. And we've worked with landlords where we were barely able to squeak out $25 a square foot because they're in the smaller strip center and they're just not willing to do it. So TI is huge. If you're focusing on retail, right now restaurant build-outs, coffee build-outs, all these spaces are costing through the roof. And we have some contractors in here, I'm sure they can tell you. It's getting really expensive to build out some of these retail spaces. this is going to be a huge contention point in the negotiation to make sure that your guys are getting enough tenant improvement from the landlord for your client.
I would add specifically for TI, it's a reimbursement. So on paper, and we've had this issue like, oh yeah, the landlord's going to give me $1 million. Yeah, and after you've spent $1 million, you know, so it's not going to come from upfront. It's not going to be the landlord's cost. No, it's going to be a reimbursement. They're not going to put a dime or penny until they see that you're committed to the space. They see that you've put in the money to there. And actually, one of the leases, they're like, we're not going to spend more than 50% of the TI. So if you know we negotiated for $400,000, for example. Let's say that the TI comes back at $700,000. That's going to get reduced to $350,000 because they're not going to pay more than your share as a tenant.
50% cap.
So, so again, this could be it varies. Like every deal is different. Leases are the most complex part of any type of commercial transaction. Leases are by far the biggest headache.
Because at the end of the day, what it is, it's two parties that are attached at the hip for 10 plus years sometimes. So those leases need to be, the landlord is committing to the tenant and his concept and sometimes putting hundreds of thousands of dollars out of pocket. Let's save was that a question? Okay, let's save that one. We're almost done actually. But you know, the landlord is committing money out of pocket and time for his space that he might have an exit strategy for his center. He's trying to build the value here with really good tenants so he can sell it in the next 5 or 10 years, for example. So if he commits to a tenant and he's putting in the money, it's a long game for him. Similar with the tenant is committing to the landlord in the space. There might be an anchor there, Walmart or Walgreens or whatever. Those are anchor spaces that bring in a lot of foot traffic for that center. So they want to make sure they're right next to an anchor that's going to bring in foot traffic. There's a lot of analysis that goes into these spaces. And then legal protections. I mean, this is absolutely huge, especially for tenants. Like I said, if there's 3 partners, those 3 partners and their spouses are co-signing on that lease. You got 3 families tied into this lease, right? Even if the concept's awesome, even if the concept has good money, their execution needs to be flawless on these spaces nowadays. And they need to make sure that they're protected legally here.
One thing I'd like to add from business operations as an agent. So 149 days is our timeline from, was it LOI to contract?
Kind of actively touching base with the client to contract.
So active client to contract. Now, pay-wise, right, you have to submit an invoice, right? And they're supposed to pay you within 30 days of receiving that invoice. Generally speaking, we are seeing 120 days for us to get paid for something that was already done. So things in commercial will go long term. You can't really count on cash flow that's going to be steady. Now, I love it because I know, hey, a deal I closed 6 months ago, I'm going to get paid now. And like once you got the operation going, it's fine. But that's one. 2, the way that commission is typically split. So we went over how it's the gross amount by whatever commission that you agree to. And again, commission on the way that residential is doing commission now is the way that commercial has been doing it before. You have to negotiate your commission. There's a commission agreement. That's what you're going to refer to between you and any party for the commission. The way that it's split, typically you'll see a lot of times you get 50% upfront at execution and then 50% at once the tenant opens and is operational and they've paid their first month's rent, right? So even if everything goes smoothly, you're still going to have that, let's say $50K split into 2 payments, and it's probably going to be between 6 to 8 months for you to get paid in full. Actually probably closer to a year. So that's typically what you see. But again, everything is negotiable. You'll have some that are going to be, let's say it's a 10-year lease. They'll pay you for the first 5 up front and then the next 5 at the 5-year anniversary. So, it's a long-term game. You really have to be committed to it. You have to also make sure that you're protecting your time as an agent. Don't go after a $5,000 lease that you're going to get paid over, a year and a half. So just keep that in mind.
Yeah. And a lot of this also revolves around the current condition of the space, right? So if it's a cold, dark shell, meaning that it's just gray walls, there's no plumbing, no electricity, what have you in this space, brand new build, the tenant is going to take upwards of a year to get this done between permitting and contracting and all that and the build out. So you're going to get paid 50% of your commission up front, which you'll chase for several months to get the accounting department for the landlord to pay you. And then you're going to have to wait another year until that tenant opens. Hopefully there's no delays, and then chase it again for the other 50%. So you can work with a lot of volume here. There's a lot more tenants than there are property owners in commercial. You just have to really protect your time. I think that's kind of the key takeaway here. Protect your time when it comes to this.